Good morning, everyone. Thank you so much for joining us this morning. Today, we will be answering some of the most common questions that are being asked right now, and our hope is to have this session be more of a conversation. And so please feel free to send in your questions, and we'd be happy to answer them at the end of this presentation. So joining me in today's conversation is my colleague and senior advisor, Paul Stages.
Hi, morning, everyone. Happy to be here.
Great. So we can go ahead and jump in with our first question, which is now a good time to invest? And the first place to start when deciding if now is a good time for you to invest in the stock market is identifying your goals and what you're planning for. So if you're planning for something in the short term, like putting a down payment on a house in the next 3 to 6 months, then investing in the market isn't the best thing to do because we just can't predict what will happen in that short of a time frame. In that type of situation, it's better to invest in a safer asset like a 6-month CD or something like that. Now, if you're planning for the longer term, like retirement in the next 10 to 15 or more years, then now is a great time to invest. You might still see some dips in the short term, but what we do know is that the market is poised to climb steadily upwards over the long term. And you'd be buying in at a relatively low period in the market like we're seeing now. So I would say the key is to work with your advisor to determine your time horizon and create a plan for investing accordingly. And what we would recommend investors avoid doing is what's known as market timing, or anticipating what the market will do in the short term and trying to profit from that by purchasing and selling different stocks at different times. That strategy has been proven to be more akin to gambling than investing, and it almost always results in lower returns over time. So with that, let's move on to our next question, which is, are we making any big asset allocation changes?
Yes, and Shweta, I would say that that's related to the question that you just answered, where whenever we're constructing portfolios for our clients, we customize it to everyone. It might be that we're using very similar building blocks among all of our different clients' portfolios. However, the way everything comes together, the amount of certain assets, such as US stocks, non-US stocks, US bonds, etc., the amount that is allocated, that is dedicated to each one of these asset classes is going to be customized to each and every person, because each and every person has a unique financial situation. They have unique goals, and the purpose of their portfolio is to help have enough resources, monetary resources, to meet those goals. So I think you said it brilliantly, where it's going, one of those factors, a key determinant, is time horizon. How far out is that financial goal that you're trying to achieve? If it is buying a home within the next year or two, then, and you have a dedicated account to that, that's going to look very different from, let's say, if you're in your 40s and you're contributing to your 401k. And so, having said that, we are meeting with all of our clients right now to understand, have there been any changes to your financial resources, to your cash flow, your income, your expenses, and have there been any changes to your goals? And if the answer to all or most of those questions is no, then we would not recommend making any big asset allocation changes at this time. If we did, then it would be, as Shweta, you said, akin to start market timing. Um, if something has changed, if it turns out that you want to work longer, if you have a home that you want to buy or a home that you want to sell, something like that that's changed in your financial situation, then we might recommend making some changes to your portfolio. But fundamentally, as an overview, if all things staying equal, then the short answer to this question is no, we are not recommending any large changes at this time. We are still, as we have this chart over here, we are big proponents of staying diversified, knowing that over time, these short-term fluctuations up and down, and especially the down that we've seen over the last few months, that you will recover in the long term. In the short term, though, that's anybody's guess. As you can see, some varied results from some previous market downturns, such as the spring 2000, that was the start of the dot-com crash. This is what it looks like for a balanced portfolio where you have 60% in stocks, 40% in bonds, which is not uncommon for a portfolio that clients of ours will have. You can see that a portfolio like this for a few years would have had relatively low returns. And then after 5 years, really strong performance. Um, After the September 11th attacks, as well as in October 1987, you saw some quicker rebounds there, but you can't necessarily expect this in this type of environment. However, what the theme, the consistent returns that we see is that typically after 3 and especially after 5 years, we do start to see markets recover. And so that's what we want to make sure that our clients' portfolios are constructed to have that short-term downside protection while also keeping you exposed enough to US stocks, non-US stocks, so you can reap the rewards of staying invested.
Great. And Paul, right now we're hearing a lot about oil in the news. Is that something investors should be considering investing in?
So again, the theme of trying to time the market continues with this question as well. The interesting thing is that I think many people might not realize just how directly and indirectly their portfolios, as well as just their entire financial picture, is actually exposed to what oil prices are doing, for better or for worse. You know, you can see direct effects if you're a driver that oil prices have come down. So when you go to fill up the tank at your gas station, you'll see that you'll save some money at the pump. However, if you have a diversified portfolio, it's most likely that you're going to be holding a few uh, energy stocks. Think of your Exxon Mobil's, BP, Chevron, etc., where those companies have been hit recently with oil prices coming down. Now, in terms of having just a dedicated position to oil, that's where it gets risky because oil is a commodity and the way it's traded on Wall Street is in futures, um, which are very volatile. And we've seen that some contracts just get completely wiped out. So if you have a position in this type of an investment vehicle, um, yes, in the good times you can see some really gaudy positive returns. However, in a time like this, you can just lose your entire investment there. So investing directly in oil prices is not something that we are recommending. Neither is increasing necessarily your exposure to the energy sector. Because again, if you have a well-diversified portfolio, you're most likely going to be holding companies who are directly or indirectly affected by what oil prices are doing with holding stock or bonds that are issued by energy companies either here in the US or abroad. So to add a dedicated position in oil at this time is again trying to time the market, and you'd be trying to bet that oil prices are going to come back with a fury in the short term, where we just don't know, because it looked 10 years ago that oil prices were just going to be going up and up, well over $100 a barrel, and now we see that it's touching well below $50 a barrel. So it's hard to predict, and that's why we're always preaching having not too many of your eggs in any one basket. This one definitely being one such basket that you don't want to have too much of your money exposed in. So those are some of the questions that we've been receiving from our clients and from other folks that we've been talking with over the past few weeks. So now we'll open up the floor to anyone who's attending this webinar live. We can help answer any questions you might have. And then please be sure to use the chat feature that is live right now. Okay, well, so far not receiving anything, but another question that did come to my mind that we have been receiving is interest rates, which were already at historical lows, have been slashed by the Federal Reserve in an effort to help ease the flow of cash to banks and then onto consumers. So that's been a bit of a positive out of everything that's going on right now. So a question that we're receiving from clients, because some of their banks are reaching out to them, is, does it make sense to refinance my mortgage at this time? So essentially lock in a lower interest rate, lower borrowing rate, in other words, than I already have. And we are strongly encouraging all of our clients to look into this whenever they get an offer, or we're even reviewing everyone's current mortgage terms to see if rates have come down far enough for it to make sense to look to refinance. So we would say definitely, if you haven't refinanced within the last several years, to take a look at this. We've had instances of clients having mortgages that they locked in many years ago, where the annual fixed rate was over 5 to 6%, and we're seeing rates that are much lower than that. And it's relatively easy. It's some paperwork that you have to submit to your mortgage representative, either at your bank, or we can put you in touch with an independent mortgage broker, and it's savings to your pocket that you'll start to see every month. So that's something else that we're hearing from a lot of our clients. Shweta, is there any other questions in the chat?
No, none so far.
Okay. So then I would say, and we'll come back to this slide here, if you do have any questions, call us at our number here, 212-374-9008. You can also email us, and I'll leave this up for a little bit here, at clientrelations@francisfinancial.com. Reach us the Twitter handle as well as on Facebook. So I'll just leave this here for a little bit. And then in the meantime, we do hope to see you every Thursday. We're doing a bit of self-care help, where every week we have either a workout with our awesome fitness expert, Dr. Laura Miranda, and then on alternating weeks, we also have yoga with our very own Deborah Donnenfeld. And so you can join in just like you did today. It's via Zoom. If you're shy, feel free to not share your camera and just follow along. We're finding that this is we've gotten some really good feedback from everyone who's joined. And so definitely feel free to join those, and we'll continue to send out reminders about that as well. Uh, in the meantime, we want to thank you again for joining us live today, and we'll be in touch soon. Take care, everybody.